Most startups don't fail because they run out of ideas. They fail because they run out of money. Why do startups burn money instead of earning profit? At first glance, it feels strange. A company is growing, users are increasing, revenue is coming in, but still it is losing money. Not a little, sometimes millions or even billions. This is not a mistake, this is strategy. 10 reasons startups burn money. 1. They are racing for market dominance, not profit. In the beginning, the goal is not to earn money, it is to win the market, because once a company becomes the leader, it becomes very hard for competitors to replace it, so startups spend aggressively to grow faster than everyone else. 2. Customer acquisition is expensive at scale. To grow quickly, startups spend heavily on ads, discounts, offers, and promotions. They are not just selling a product, they are buying attention, and attention at scale is costly. 3. They sacrifice margins to kill competition. Startups often sell products at very low prices, sometimes even at a loss, just to attract users. This forces competitors to either match those prices or lose customers, slowly pushing weaker players out. 4. Building infrastructure requires huge upfront cost. Technology, logistics, warehouses, hiring talent, everything needs investment before profits come in, so money goes out first while returns come much later. 5. They are funded to grow, not survive. Investors give money not for stability, but for growth. They expect startups to expand aggressively, capture markets, and scale fast, even if it means burning cash in the process. 6. Network effects reward early expansion. In many businesses, the more users you have, the more valuable the platform becomes, so startups focus on getting users first, because once the network is strong, monetization becomes easier. 7. Revenue comes later, scale comes first. Many startups delay profitability intentionally. They first build a large user base, and only after that do they start increasing prices or introducing monetization strategies. 8. Competition forces aggressive spending. If one company starts spending heavily to grow, others are forced to do the same, otherwise they lose market share. This creates a cycle where everyone is burning money to stay in the race. 9. Valuation depends on growth, not profit. Investors often value startups based on future potential, not current earnings, so a company growing fast can attract more funding even if it is not profitable. 10. The goal is long-term control, not short-term income. Startups aim to become dominant platforms or market leaders, because once they control the market, they can later increase prices, reduce costs, and turn profitable at scale. Real-world example. Imagine a food delivery startup entering a new city. At first, it offers huge discounts, free delivery, cashbacks. Customers love it. Orders increase rapidly, but the company is losing money on every order. Why? Because it is not trying to profit today. It is trying to become the default choice. Once people get used to ordering from that platform, once restaurants depend on it, once competitors are weakened, then slowly, discounts reduce, prices increase, and profits begin. The loss was not failure. It was the cost of becoming number one. If you want to understand money, power, and how the system really works, subscribe to the channel.